All right. Hey, everybody. Thanks so much for tuning in to Young Money Investments. This is episode 3 we have with Jonathan here, kind of in this new little series that we're doing on teaching new investors, these little young buck investors, some of these basic terms in terms of trading, what they mean. I think Jonathan's had a lot of questions about, the basics, what they mean. What were the main ones that you wanted to go over today?
Day trading, swing trade, and short.
Short. Okay. And then we're also going to talk about long-term trading as well, because that's one I think that everyone needs to kind of start out with, because it's the least risky, and then we'll work our way down. So that's kind of what we're going to get into today on Young Money Investments. All right, so number one, the first term that we're going to go over today is long-term investing. So when you hear the term long-term investing, what do you think it means?
Just like months.
Long.
Somebody investing long term,
Yeah.
couple months.
It's exactly
Yeah.
it's exactly
Years
what it is.
even too.
Yeah, it's exactly what it is. You want to hold a position. Usually a long-term investment is going to be anywhere from a year to probably 3 to 5 years. It's going to be a long-term hold. You're not going to pay short-term capital gains tax on it as well, which is nice. You're taxed less on a company that you hold longer than a year. So I always recommend that as well, because you don't get taxed as heavily on your long-term investments. I think everyone needs to probably start out doing some long-term investments and getting kind of the feel for those things. All right, so the first thing we are going to talk a little bit about today is long-term investing. So if you can't read this, long-term investing is holding a company 1 to 5 years or even more. So if you're long-term investing in a company, you're going to hold it for a long time. Some of the big benefits that you're going to get with long-term investing are things like you're taxed less. So when you're investing in a company and you sell it in less than a year, you get things what are called what is it? Taxable. I just told you the term too. What was it called? Short-term capital gains. So if you buy or sell a company in less than a year, the government kind of does this because the government wants you to stay to help big businesses. The reason you're investing in a company to begin with is because that money is supposed to help the company grow, right? The money that you're putting in that company, they're supposed to be able to take that money and invest it in new products and employees and buildings and those kinds of things. And so the government gives you a tax benefit by you keeping your money in a company long term. Does that make sense?
Mm-hmm.
So that's one of the benefits of a long-term hold, or investing long-term. Another big thing is you have less risk, because it doesn't matter if there's dips. We've seen it. Even good companies, even like Amazon, it had that 20% dip within the past year. It's still going to go up long-term. Yes, it'll come down, but you don't get as scared. When if you had a company and it sold off 20%, you'd maybe get scared and want to sell out. If you're short-term investing, if you're long-term investing, you go, well, I still believe in the company long-term. I'm going to keep holding it, and I'm not worried because I know it's still worth a lot. Another thing with it is you got to find good, strong companies. They're called blue chip companies, or big businesses that are worth billions of dollars. And so when you find companies like that, it's actually really good because it's just less risky. You want to find strong companies that you see value 5 years from now. And then the last thing for it is it's just good for new investors because it's less risky. They're companies that usually. They're companies that you usually buy products in, and that's kind of your long-term investment. All right, and so number 2, the second term that we're going to go over is going to be swing trading. So Jonathan, what do you think swing trading is?
Now that I see it.
You got to tell me. Give me some of your ideas on what do you think swing trading is.
Actually, I had no clue.
Oh, you just saw it though.
What?
You just saw it though.
Well, yeah, it's short trading. One or a couple weeks or so.
So swing trading.
Couple months.
Okay.
But yeah, that's pretty much it. I mean, we were just talking that the shorter the trade, the more experience you should have.
Absolutely. So that's kind of my rule of thumb with trading, and this doesn't mean that's for everyone, right? But my rule of thumb has always been long term has less risk involved in it,
Mm-hmm.
right? Because you're not playing the dips. The shorter the time, the more inherent risk that you have with a
Yeah.
company. And so, swing trades are going to be kind of the best of both worlds. You get to kind of trade your stocks, play with them a little bit more, but you're not day trading and potentially, using a large amount of cash and a lot of capital to make a small percentage gain, but still trying to make a lot of money. Because that's the thing is, in order to be a good day trader, you have to move sometimes, tens, if not hundreds of thousands of dollars, and you just trade it off of a couple cent change in a company. But that also means that if it changes a couple cents in the wrong direction, you can lose a lot of money as well, right?
Mm.
So that's why it's more risky. That's why as you get down. But what I wrote down for swing trades on here was, and this is going to be probably hard to read still. I wrote that swing trading is best usually between 3 days to 1 to 3 months. So that's kind of my time frame on a swing trade. My swing trades rarely do end up being 3 months, but I usually keep them shorter, but that is kind of the time frame that I'm willing to do a swing trade. Now, I like taking swing trades that if they don't play out good in the short term, I buy good companies still because I can then see long-term value in them. So I
Mm.
usually like buying companies that sold off, and this is kind of what I wrote over here as well as you're still picking good companies. Sometimes these are companies in a swing trade that you'll buy because they sold off because of bad earnings or they had bad news on the company, and so they're undervalued. They lost a lot of value,
And that's what you
um,
want to buy.
and that's when you want to buy. If you still see the fundamental value of that company being high, it's just that maybe so every quarter, like we are talking about, every
Mm.
4 quarters they report earnings. Let's say maybe the analyst said that they were supposed to make $1 billion in revenue and they only made $800 million, right? They missed pretty, or let's say they made $900 million. They didn't make a billion. They were like 100 million
Yeah.
short. The company would lose value. People would probably sell off the company, but that doesn't mean that long term. It's just maybe it was a slow quarter or something like that, right? The fundamentals are still there. People oversold and they just panic sold, and it's a good buy because it's going to recover
Yeah.
from that. So that's usually what I do with a swing trade. It's also medium risk as well. Like I said, you're not day trading. It's not as much risk. You're not playing as much of the fluctuation, but you're still playing a little bit more of the chart pattern. And that's where with this you're going to start using the charts and using what's called technical analysis, or using the TD Ameritrade
Yeah.
Thinkorswim to not use Siri. Technical analysis. I don't know if that's where she got it from. Um, you're gonna start using the chart patterns to go, okay, well, it's finally hitting resist or support, and it can start coming back up and trending up. So that's kind of where, like, what this is what I like to do. That's like my favorite type of trading
Swing
right
trade.
now. Exactly. And then we're gonna go into the last one that we'll talk about. So, Jonathan, last one we're gonna go over here, or sorry, second to last one. Last one in terms of like the styles of trading is going to be day trading. So, what is your understanding of what a day trade is?
Trading for a day. I think
Trading for a
it's
day, pretty simple, right? What are your understanding in terms of like risk level with it? What's your understanding with like I don't know, like experience level? Like what are some things? I mean, have you seen Wolf on Wall Street? Have you heard about Wolf on Wall
I have
Street?
heard
Like,
of it. I haven't seen it, but I think I guess for this type of trade, you have to pay more attention throughout the day, every minute, pretty much what's going
absolutely.
on. So you have to be more on top of it than, for example, long trading,
Absolutely, absolutely. I think
long-term
and I
trading.
didn't bring
So
that up in any of the other points with this as well, is these different levels, whether it be long term investing, swing trading, or day trading, they each require more and more of your time, and it's a time
attention, yeah,
investment, your attention. Exactly. If I'm in a day trade, I'm not just going to hop up and take like a 4 hour nap or whatever and be
yeah,
like, oh, I'm going to leave my money in there. No, because like you
yeah,
can risk. I heard of a story of a guy. He had like $100,000 in like a short on Tesla or on Apple, I mean, and something happened. I don't know if it was earnings or what it was, but like he like lost all of his money and then some. He like lost like $120,000 like instantly because he went into like a boardroom meeting and like just got hammered. I don't even know the company actually now I think about it, but the thing is you have to pay a lot of attention if you're day trading, and it's even more than just the time. But you're absolutely right. Like more time, day trading is like the most time consuming. You have to be in front of your charts, understanding, kind of going over that. So that's kind of what I put on here. Basically, with day trading, maybe I should pull this up here so we can kind of see what's going on. The thing with day trading is that it's going to be intraday trading, just like Jonathan was saying. It's going to last anywhere between a few minutes or anywhere between a few hours. I've been in a day trade one time when I first started trading. This is when I first started day trading. I got into this like chat room or whatever. And I was like, oh yeah, this guy's so good. I'm just gonna get into every single trade that he does. I'm gonna play it the way he does, and I'm gonna make thousands. I was like, oh, I'm gonna make lots. And so I got in on this trade, and it was like a penny stock company. And that's another thing. Day trades are usually a lot in penny stocks because they're very volatile. And I don't like super volatile. That's why it's more risky. And I got into this company, and I kid you not, like it went up at the very beginning, and I was up like $100 all of a sudden. I had like probably like $8,000 in this company or something, and I was like, oh, I'm gonna make so much money. And then like it just started tanking, and like I literally got out and I lost like $3,600 in like 12 minutes. Like it was the fastest way I've like ever lit money on fire in my life. Like worst investment I've ever done. And my brother, I even had him on the phone, like told him to put money in it, and we both freaking like just lost our shorts in it. And so like that's why like I highly discourage people from day trading, because like if you don't understand it, you will lose so fast. Like it's like dog eat dog in the day trading world, especially penny stocks. Like a lot of people ask questions about penny stocks. I'm not a big fan of penny stocks because I don't understand them enough. You have a question, Bob?
Yeah, just couldn't you just hold that example to swing trade? Like if you had that money and there it was going down,
But
couldn't you just wait it to
I
the?
could, but it's a company that was continually going down. I was investing because even companies that are trending down, sometimes they'll pop up a little bit, right? And then they'll keep going down. No company just goes straight down, 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 down. They sometimes have a pop, right? And so I was trying to play the pop on this company that was garbage, basically.
Oh, okay, so it was a bad company to invest in.
The reason companies are penny stocks is because they're usually a bad garbage company to get into.
Oh.
There's a reason no one wants to hold it long term. There's a reason why it's trading at 4 cents a share, because it's not good.
Okay.
And so, yeah, I couldn't swing trade it because it was just going to continue to tank. Yeah, so it did bounce back a little bit, and I probably only would have lost like $1,000 if I would have stayed in it longer that day, which really sucked because like I sold out like right at the bottom. But it was a good lesson for me to learn, like, don't like just don't get into something you don't understand, and don't put all your eggs in one basket. So it sucked really bad.
What happened to the guy though
What guy?
that you were listening to?
He made like $100 and sold out. Like he
How
sold
come he
out right
didn't
away
sell out at the
because
same
he had a
time?
faster broker than I did. He was using a paid broker, and I was using Robinhood. And that was when I learned, don't day trade penny stocks with Robinhood. Like worst idea ever. Worst idea you could ever do. So
So I guess that's it.
I made like $27 the other day, Joe.
Oh yeah.
But
Oh yeah.
So wait, so
that's
bro,
the exception, not the rule.
27.
That's not the rule.
Yeah.
I mean, so broker, so
So a broker is like TD Ameritrade,
So that's the
E-Trade,
broker, okay.
Robinhood.
his broker was faster.
He was using because he was paying. Yeah, he was paying money, and he understood the chart pattern. Like he only was like, I'm only going to make 20 cents on this, and I'm going to sell out and make my profit. I was like, oh, it's going to keep going up. I was just like, oh, it's going to keep going. I didn't have all the charts. I didn't understand, and I got just burned my freaking shorts off me. So it sucked really bad. But yeah, that's basically day trading. Requires a lot of money to make a quick profit because you're only in it for so long. You're basically playing like if it goes up 10 to 20 cents, you're getting in and out. But with that, so that means if you're only making 10 to 20 cents on a share, you're needing like 1,000 shares, right, to make like a couple $100 or something. So you need a lot of capital, and it's very risky because if it can go up 10 to 20 cents pretty quick, it can also go down 10 to 20 cents as well. And when you're in penny stocks like that in day trading, you got to make sure that there's other people on the other end willing to buy those shares back from you at that price point,
Yeah.
or else you're stuck.
How
So
do you know that if they're
so
people willing to?
you know off of something called the level two. So there is a thing on TD Ameritrade. It's not on Robinhood. So with level two, you can actually see if there's buyers for those shares and at what point they're willing to buy those shares and how many they're willing to get it. So that's another tool. We'll go into that like on another video, but that's way down the road. I don't want anyone really worrying about level two or worrying about that stuff yet. But you should know things like what an EMA line is. That's your exponential moving average. It's a mathematical formula that creates a line. It shows whether it's a good buying opportunity or selling opportunity. SMA is a simple moving average, and I use that over 180 days. RSI stands for Relative Strength Index, and that's that little chart on a TD Ameritrade at the bottom that shows whether a company's overbought or oversold. And I use that for a lot of day trades and swing trades. But yeah, it's a lot of info.
So this is why you want to be more experienced in that, because you need to know all
Absolutely.
these things.
These terms and
These
how
terms,
they
yeah.
work, and yeah.
Yeah.
So
Okay.
yeah, that's why I just don't recommend getting into it. Yeah, I mean, learn, practice, do the paper
Mhm.
trading, practice on the paper trading platform, and then you can start to get into it. So many people get into it too early, like I did, and you lose a lot of money. I had more money than sense at that point. Like I should have thought about it. I got greedy. Like greed is the biggest way to lose massive sums of money. So yeah, that's day trading. So Jonathan, we are going to go over the fifth, what is this term? One, two, three, four, fourth term, fourth and final term, and this is shorting. And I know you've had a few questions about what shorting is. I know I've kind of explained it a little bit to you, like here and there, but what is your overall idea of what a short is? How do you make money off of a short? What is a short?
Um, I, I really don't know.
Okay.
I thought it was like making money off of people selling or something to share. I don't know. I really don't know.
Okay, you're
That's why I
good.
wanted to get
Most
into it. But
most people don't know what a short is, and I didn't really understand. No one ever really explained to me what a short was, and I had to like watch a ton of YouTube videos to figure this out. So this is the best example that I've come up with that made the most sense for me. So a short is basically a way that you make money off of a company going down or losing money. So let's say Tesla is trading at $300 a share and you believe that they're not going to make the Model 3 in time. Or let's say you think that Tesla is overvalued. People believe in Elon Musk too much, and you really think that electric cars aren't the way of the future. You think that gas is the way to go. You believe in oil. You believe in all that stuff. You don't believe in Tesla. So what you can do is you can borrow shares from someone else, and then what you do is you make money by those shares going down. So the way that I kind of explained a short working, and I just said you make money. So the way you make money on a short is by making money when a company is bad or doesn't perform well. So what you do, in this example that we have over here, you have guy number one owns 10 shares of company A at $10 a share. So he has $100 worth of this company A, right? And these shares are worth $10 a share. What happens is guy B comes to guy A and says, hey, I want to borrow your shares from you. He says, I want your shares and I'll give you maybe 5% interest on you loaning me your shares for a year. Let's say he offers a 5% APR on borrowing this guy's shares, right? It varies per company, but let's just call it 5% for easy math, right? So what guy B is going to do is he's going to say, hey, guy A, will you give me your 10 shares? I'll give you, he said, I'll write up a contract and I'll give you these shares back at the price of $10 a share, plus I'll give you 5% on that. So I'll give you $105 worth of company A when all this is done, right? It's guaranteed money. So guy number one is going to get his shares back plus 5% on his investment. And guy A or guy number one, guy A is going to go, yeah, that's easy money, because he's like, I believe in Tesla. I think Tesla's going to the moon. I think this company is going to do great. So I don't know what this guy's thinking. Sure, I'll give you my shares. I'll make money on this. Plus, I'll make money as it continues to go up. And so what he does is he gives his shares to guy B. Now, the way guy B is planning on making money is he will take those shares, and the market is trading at $10 a share, right? What he does is once he has those shares, he instantly sells those shares. So he sells them back on the market, and now he has $100, right? He got the money from those shares.
Mm-hmm.
Now, what he's expecting this company to do is to go down. He expects to see company A, or we're calling it Tesla at this point, right? He expects to see Tesla go down in value, right? Because he's going to make the difference in what the shares drop to. So what would happen in this example is, let's say it starts out at $10 a share and it drops to $9. Well, now he's made 10% on his investment right there, right? Because they're at $10 a share. Now they're at $9. The shares dropped 10%, right? Minus his interest, which is 5%. So he would be at 10. Does that make sense?
Okay. So he sold them off.
Yep, sold them off.
This high.
Yeah, he sold them off at $10 a share.
$10
right
a
here.
share. Okay.
Yep.
And now, so
And
he
then
doesn't have any shares.
He doesn't own any of the shares. He
Okay.
needs to buy them back at a lower price in order to make money, right?
Exactly.
So he needs to make money by the share going down. So he's going to hold off. He's going to wait. He's not going to own any shares. He just has an obligation to pay guy A back eventually at that $10.
So he's never going to make more than what he originally bought them from then.
No, he does, because this is how he does it.
Okay.
So how he does it, right? So as time goes on, if he sold at $9 right here, he would have then, he could buy back those shares, 10 shares at $9, right? And what's 10 times 9?
10 times 9, $90.
$90, right? And he owed the guy 5% of $100, right?
Which is $105.
Which is $5, right?
Which is, yeah, so
$5.
he owes the guy $105.
He'd owe the guy $105. If he bought 10 shares back at $9 a share, he would be only spending $90, right?
Mm-hmm.
So he would have profited $10 by buying them back at a cheaper price.
Yeah.
And then he would still owe him another $5 for interest. So he would have made $5 basically on that short in this scenario. Does that make sense?
Okay, yeah.
We'll keep going. I'll give you another example on here. So let's say the company went down and he didn't buy those shares back at that price. Well, now it's back up at $10, and he's like, oh crud, I'd actually lose $5 because if I bought them back at the same price, I promised to pay him back 5%. I'd lose money at this price. So he's like, I can't buy them back here. Well, then it drops to 9, and he's like, I think it could go lower. I think it could still go lower than 9. I'm not going to buy back in there. Well, he waits, and it starts to get more expensive. So this is where Guy B gets in trouble, is because the company is worth more money now, and he's losing even more. So this is why shorting is really risky, because this company could go to 0, right? And the guy he would basically double his investment, right? Basically.
Yeah.
Well, if the company goes up, it could go up to $11, $12, $13.
So when it goes up, wouldn't Guy want his shares back to sell them, or
Well, he believes that it could go higher, so he doesn't care.
He doesn't care.
He doesn't. He's not looking to sell them at any price point right there. He's like, hey, just give them back to me. I think this company could keep going up.
In the contract, does he say at a certain time?
They sometimes do. Sometimes there's a time limit on how long you can keep them. Sometimes there's not. But see, this is the problem: is with short selling. If this company is up here at like $13 now,
you've lost so much money.
You would have to buy those shares back at 13. You would spend $130 plus the $5 in interest. You would owe him 30. You would lose $35, or 35% of your investment would just be gone because you had to buy more expensively. And this is the problem with shorting: is if this company, let's say this company went to $100 a share, he would be losing massive amounts of money, right? Guy B would. Guy 1 would still be happy because he still gets his 5%, plus he gets his shares back at 10%, or at $10, and so he's good. But this is where Guy B starts to make money, is once it starts coming back down, it drops down here to $7, and then it's $7.50, and then it drops down, and we're down here now at, let's say it's at $5 a share. So this company,
$50.
and this is where, if you're a short seller, this is where you make your money now. It's at $5, and let's say he goes, you know what? That's what I wanted to make on it. He goes, that's about as low as I think it's going to go. I'm going to buy those shares back. And so what he does now is he's going to buy these shares back
at $50 total.
At $5, $50 for those shares. And he owes the
other guy $5, so he's making $45.
Exactly. So he just made a 45% profit now off of that.
Oh,
because the company did bad. Exactly. And so
interesting.
then he bought those shares back at a cheaper price. He keeps the profit, pays his interest, bada bing, bada boom. So shorting can be very lucrative. You can make a whole lot of money doing shorts. Um, because sometimes people go, oh, I know a company's going to do bad, right? I know this company's like Blockbuster, right? A few years ago, if you would have seen Netflix or Redbox coming out, you'd have been like, easy money, right? Like that's not going to be worth anything, and you could make it, make bank. Um, the thing is though, is if the company starts to do well, you could lose infinite
Yeah.
amounts of money if you don't cover your position. And so that's kind of the cool thing though with shorting is you can make a lot of money. Like I have a friend Rhett. He's the one that like went from like $30,000 to
100,000.
$900,000 in a year
$900,000.
in 10 months. Yeah,
Oh my
he did a lot of
goodness.
that shorting. He would short massive amount. He'd do massive shorts, and he would just make money on the downside. So shorting can be really great, but you're not going to be able to do shorting on Robinhood. It's hard because sometimes you can't acquire the shares. There's no one that's willing to give you the shares of their company to trade. Sometimes it's really expensive to borrow those. The interest rates are super high, and so that's hard to do as
Mm,
well. There's just a lot of things that go into shorting that the new investor just doesn't know what to do.
yeah.
There's things called options trading, which you can buy calls, which is you think the company's going to do better. We won't go into options trading right now, but there are ways to do what's called a put option and buy, basically bet that the company's going to go down. I just don't like those ideas for new investors. I think it's good to stick with this, and as time goes on, start branching out. But um, that's kind of shorting. I mean, it's not a bad thing to get into if you understand certain things. But I don't like doing long term shorts. If I'm shorting a company, I'm like it's a day trade short. It's usually what I the way I do it is I go, okay, this company just went up 8% today, right? 8% is a large jump in one day, and I'm like, it's going to pull back a little bit. It means that people overbought that company, and it's going to sell off a little bit the next day. And so I'll sometimes do that.
Have you done shorting before?
Yeah, I've shorted. I think I made uh, like $1,300 shorting Tesla last week, but it took like a $56,000 position. So it's one of those things like you can make a lot of money. Like I said, shorting, and it's good. I just don't recommend getting into it because you do need to use TD Ameritrade or another E-Trade or a different one besides Robinhood in order to do it. Um, and most people, like I said, just don't. There's so many other steps in it because you have to understand interest rates of what you're getting it loaned to you for. You have to understand if it's APR on the interest, if it's daily compounding. If you short a company intraday, there isn't interest on it, I don't believe. But if you hold it overnight, then that's when the interest starts to accrue. Um, it's just it's a little bit more
So
technical.
a lot of compared to the other ways of trading, that's the most advanced then,
Um,
would you say?
yeah, I mean day trading, whether it be I guess it
Day
would be
trading
day
and
trading
shorting, I mean.
is risky, but yeah, I'd say shorting is probably the one of the more advanced methods, and then options trading is going to be just as advanced as shorting. So
So shorting, you have to be kind of like day trading. You have to be on top of it, like paying attention to it all the
yeah, because
time.
if that company rips up and shoots up, right, you might want to you might want to buy your shares back right there because what if it keeps going up? You do want to be a little bit more on top of it. Some people will do long term shorts, like people have a long term short position. A lot of people have long term shorts in Tesla right now because they don't believe that, they believe that Tesla's overvalued, et cetera, et cetera. Um, but for the normal person, I'd say you don't want to be in a short too terribly long. I don't know because I don't want to pay interest on it long term. That's my thing with it, is because not only do I now have to um, make sure that it's going down in value, and the market as a whole right now is going up. So you're almost betting against the market right now. You have to really find crappy companies in order to make money
Mm.
in it because overall the S&P 500, the Dow Jones Industrial Average, the Nasdaq, those are all going up overall. Most companies are doing better right now. And so you're having to find those companies that aren't making money and then also pay interest on that money that those shares that you're borrowing. So it's just more risky right now. In a recession or in a downturn in the economy, yeah, shorts are great, right? Because everything's going down. So yeah, that's everything. So any more questions?
Good.
Man, I think we covered a whole bunch of stuff in this video. I think we're going to have to edit this down a whole bunch. But thanks so much for tuning into Young Money Investments. Let's thank Jonathan for getting to be here and for giving us some new trader insights and some of those questions that I'm sure a lot of you all probably have as you're starting to get involved in the market. So thanks so much for tuning in. Talk to y'all later. Bye.